The floating rate bonds are typically medium-term bonds. And as I said, more often than not, they're issued by either financial or non-financial corporations. It would be rare to see governmental institutions or uh, institutions like World Bank or IMF to fund their operations to issue floating rate bonds. These are, bonds that are issued based on some sort of index, you know, maybe SOFR rate plus some sort of spread. The reason you want to do it based on some sort of index, more often than not, there's a futures market that can be used to manage the interest rate risk, which we're going to cover in chapter 14. And the way the price of uh, floating rate notes uh, vary is different from fixed rate bonds. For example, let's say the Turkish government issued a 10-year fixed rate bond, and let's assume they issued that at 7%. And 2 years later, uh, overall interest rates, even without a change in credit rating of Turkey, went from 7% to 10%. As an owner of that bond, I'm going to see a significant decrease in the value of that. Typically, a 10-year bond like that will have a duration of 7 years, which means every 1% increase in the yield will decrease the value of the bond about 7%. So if I'm a bond investor that bought the 7% bond, if the interest rates go up to 10, I'm going to lose about 1/5 of the value. Okay. I mean, if I'm going to hold it until maturity, it doesn't matter too much. But if at some point I'm thinking about maybe selling it, I cannot sell it at a high rate. Or if I'm funding that through something like a repo facility, I could be funding the whole $10 million, but suddenly I can use only about $8 million in repo market. I need to get funding from somewhere else. Floating rate bonds, on the other hand, in the absence of credit rating changes, are stable in value. Because if you think about floating rates, if SOFR is 4% today, this will not affect the value of the floating rate bond too much. Yes, the yield of the bond went up, but the coupons are also going up. So I'm discounting higher coupons at a higher rate. So if you think about instantaneous term, I issued the bond today. By evening, Fed did something so that SOFR rates went up by 3%. the value of the floating rate bond is going to stay exactly the same. What makes a difference is that spread. If at the time I issue the bond, my proper spread is 3%, but my credit rating went down, in order to attract new investors, I have to increase the spread, right? You know, U.S. used to be a AAA rated country. Now we're only AA rated. Okay, that spread is going to go up. That's the fixed part. So even if SOFR doesn't change, that's going to actually affect the value of the bond. But the effects, the price effect, comes through only, I should say mostly, just to give you an idea. If you wanted to know, I don't know why I can't make this thing go away. Just to give you an idea, what's the difference between spreads of AAA rated versus AA rated companies? There's a database maintained by Fred St. Louis. It's called Fred St. Louis. Fred is short for Federal Reserve Economic Data. I'm going to search for, where's my search button? Let's say AAA option adjusted spreads. It's kind of an index. Right now, that's 30 basis points, okay? This is spread over the treasuries, not necessarily over SOFR, but so if you have a 30-year, 10-year bond, currently the 10-year US bonds are yielding 4.03. So if I'm a corporate issuer with a AAA rating, I should expect something around 433 as the yield. Of course, this is kind of an average, even among AAA rated firms. There is a distribution of the credit quality. But on the other hand, if I'm a AA rated, I should expect 43 basis points. So instead of 433, I should expect a yield of 46, something like that. Or maybe single A, another 20 basis points or so. Or if I'm a country with triple B, triple B is the lowest rating you can get while still being considered investment grade. For example, uh, public pension funds by law in the US cannot invest into anything that is not rated AA or AAA. And mutual funds who are not in the business of speculating on credit quality. Suppose I'm a mutual fund that mainly invest in stocks and bonds, but they can change what percentage are in stocks and bonds. They can invest on anything that is investment grade. So let's say I'm an aggressive uh, value stock fund, something like that. But sometimes you also change how much you want to put in stocks. They can invest in the triple Bs, but anything below that, they cannot.